Hello, everybody. My name is Gregory Joos. I'm the partner leading the financial services practice of PwC in Belgium. And today I will talk about risk management in banks. As you know, banks are playing an essential role in our economy. Their primary and historic role is to transform client deposits, mostly short-term excess cash, into loans, mostly longer-term financial means for households, SMEs, and corporates, and hence they finance the economy. Over the years, banks have also started to develop other financial services which play an important role in our economy, such as, for example, asset management, corporate finance, or other advisory services. In their role as intermediary between those different economic agents, banks also run a number of financial and non-financial risks. Financial risks are, for example, credit risk, interest rate risk, liquidity risk, and market risk. Non-financial risks are, for example, but not limited to, operational risk, reputational risk, and legal and compliance risks. The banking industry and the broader economic and regulatory environment in which banks operate are, however, in continuous evolution. And hence, risks also evolve and new risks emerge. In today's increasing digital banking industry, relying on automated processes, decisions are more and more driven or influenced by complex mathematical models, data analytics, artificial intelligence, and machine learning. Imagine what happens if all the decisions to grant credits are automated and would be based on a model which is not adequately designed. Well, either the outcome of the model would be too prudent, and the bank will refuse a lot of credits to clients which are good clients, which have a good credit quality, and hence the bank would lose a lot of business, or the model might not be prudent enough, and hence the bank is granting loans to a lot of customers with a bad credit quality, and the bank runs a lot of credit losses. And hence these models create new risks, and the quality of these models need to be closely monitored. Climate risks are the consequences of global warming. We make a distinction between physical risks and transition risks. Physical risks are the direct consequences of global warming and climate change. They do not necessarily impact the bank directly, but can severely affect the bank's clients and indirectly the bank. Think about the bank granting mortgage loans to households in areas which are subject to flooding, or loans to corporates having factories in areas with an increased risk of forest fire. This will indirectly impact the credit risk of the bank through the financing of these clients. The transition risk relates to the risk of the transition from the current brown economy to a greener economy. Certain industries and companies will be winners, whereas other ones will be losers. For a bank, it's extremely important to understand in their clients who will be those losers and those winners. And that will play an important role in investment criteria or loan acceptance decisions. More and more, we see banks outsourcing activities to specialized service firms. Banks creating partnerships with other actors, sometimes actors outside the financial services industry, or even banks creating whole new ecosystems. Well, this also creates new risks. What happens if you have outsourced a number of critical functions to a third party who has a weak control environment and is not able to deliver the quality you need as a bank? Or even worse, what happens if that third party would default and not be able to fulfill the critical function anymore? Or there is a big data leakage. So all those risks are risks which a bank needs to consider when they outsource important processes. So managing the third-party risk becomes a real priority for the banks today. In our digital and cashless world, the risk of a bank robbery on a branch has been replaced by a digital robbery, or in other words, cyber risk. The difference, however, is that the loss for the bank can be a multiple of what the bank is losing in case of the robbery of a branch. These days, of course, we cannot ignore COVID-19. COVID-19, which has a huge impact on all of us, on the society, but also the economy, and hence on the banks. First of all, there was the impact on operational risks. Suddenly, whole organizations had to adapt their way of working, with the majority of their personnel working remotely or in alternating teams to avoid the risk of contagion. This has an impact on the functioning of the bank because it limits the ability to interact face-to-face with clients. It creates issues in processes which are not yet fully digital and create challenges in leading teams and human interaction. The sanitary crisis also impacted financial markets. We've seen unprecedented volatility on those markets, and that impacted market risk of the banks. The central banks tried to support the economy, but those actions had an impact on interest rates, a decrease of interest rates, and hence impacting the interest rate risk of the bank. Corporates started to draw on their credit lines, which on their turn impacted the liquidity risk of banks, and liquidity risk needed to be monitored more closely. And the biggest impact will probably be the impact on the credit risk. Currently, households and businesses are still supported by all the measures taken by both the sector, banking sector, and the government. There is the payment moratorium, there is the guarantee from the government, there are the temporary unemployment measures. But the big question is what will happen when these measures will end, and how large will the damage be for the economy and indirectly through credit losses for the banks. Banks can of course hedge a number of these risks, but that has a price, and a bank hedging all those risks will not be profitable. Hence, risk management is at the heart of the strategy of a bank and will be a key driver for its profitability. It all starts with defining the risk appetite. For each type of risk, the bank will have to define what is the level of risk the bank is ready to accept. These are decisions which are taken at the level of the board. So these are important decisions, and they will drive the strategy of the bank. Risk appetite will result in the definition of limits and the implementation of policies and controls throughout the whole organization. This, of course, is an iterative and dynamic process, which needs to be adapted to cope with the evolving environment and to incorporate emerging risks. This all makes it a fascinating subject. Thank you all.